All right, let's talk Wall Street. We're going to tackle that complex, kind of intimidating language of the stock market and translate it into plain, simple English. The goal here? To help you understand what's really being said behind all that jargon. So let's dive right in. You know that feeling, right? You turn on the financial news, and suddenly you're hearing about bulls and bears and bubbles, and you're thinking, do I need some kind of secret decoder ring just to follow along? Well, if you've ever felt that way, trust me, you are not alone. It's a super common feeling. But here's the good news. It really doesn't have to be that confusing. Think of us as your personal translator today. Our whole mission is to break down the essential vocabulary, the real must-know terms, so that by the end of our time together, you'll have a super solid foundation to build on. Okay, so let's start at square one, the absolute basics. When you hear people talk about buying stocks, what does that actually mean? Like, what are you physically or, well, digitally buying? Well, it all kicks off with something called a public company. Now, these are the businesses you hear about every day, from the absolute giants to smaller companies you might not have heard of yet. And what they've done is they've decided to sell off tiny pieces of their ownership to, well, people like us, to the public. And they do this on a stock exchange. Why? It's how they raise money to expand, innovate, and grow. And that little piece of ownership, that, my friends, is a stock. Each little unit is called a share. So when you buy a stock, and this is the key thing, you're not just buying some random number on a screen. You are literally buying a tiny, tiny fraction of that company. And that, in turn, makes you a shareholder. That's the official name for it. The moment you own even one single share, you are officially a part owner of that business. You've got a stake in its future, its successes, and, yep, its failures too. So if you remember one thing from this section, make it this: stock equals ownership. Simple as that. All right, so we've nailed down what we're buying. A piece of a company. Now let's switch gears and talk about where all this action happens. Where does all this buying and selling actually go down? This is where the stock exchange comes in. You've probably heard of the big ones, right? The New York Stock Exchange, the NASDAQ. The best way to think about it is like a giant, super organized auction house. But instead of art or antiques, they're trading pieces of companies. It's the central hub where buyers and sellers all come together to agree on a price. But here's the catch. You and I can't just stroll onto the floor of the New York Stock Exchange and start shouting, "I want to buy." We need a go-between, a middleman, and that's where a broker comes in. Back in the day, this was a person on the phone, but now it's usually an online platform or an app on your phone. They're the ones who take our orders and execute the trades on the exchange for us, usually for a pretty small fee. And at the heart of every single trade, there are two key prices. You've got the bid and the ask. The bid is simply the highest price a buyer, somewhere out there, is willing to pay for a stock. And the ask? That's the lowest price a seller is willing to let it go for. A trade only actually happens when a buyer and seller agree, when the bid and ask prices meet. That's when the deal is done. So just imagine millions and millions of these little trades happening every single day. But what happens when you zoom out? How do all those individual transactions add up to paint a bigger picture? How do we talk about the overall feeling or the mood of the entire market? This is where you get those two famous animals, the bull and the bear. I'm sure you've heard these terms thrown around. A bull market is when everyone's feeling optimistic, the economy's humming along, and stock prices are generally on the rise. Then you have the opposite, a bear market. That's when pessimism takes over, people are worried, and prices start to fall. And the reason for the names is pretty cool. It's based on how they attack. A bull thrusts its horns up, and a bear swipes its paws down. Okay, next up is a word that kind of describes the personality of a stock: volatility. All it means is how quickly and how much a stock's price jumps around. So a big, stable, old-school company might have really low volatility. It doesn't move much. But a brand new tech startup, it could be all over the place, with its price swinging wildly up and down every single day. That's high volatility. And sometimes that optimism, that upward momentum, it just gets completely out of control. That's when you get a bubble. This is when pure hype and excitement push prices way, way beyond what an asset is fundamentally worth. People get caught up in the frenzy. But like any bubble, it can't last forever. Eventually, reality kicks in, the bubble pops, and prices can come crashing back down to earth. So, given you've got bulls, bears, and all this volatility,
How do people actually invest? Well, it's not usually just random guesswork. Most investors follow specific strategies or philosophies to guide their decisions.
Let's look at two totally opposite approaches. First, there's going long. This is the one you probably already know. You buy a stock because you think its price is going to go up. Buy low, sell high. Simple enough? But then there's its polar opposite, shorting a stock. This is when you're actually betting that a stock's price will go down. It's way more complex. You borrow shares, sell them immediately, and then hope to buy them back later at a cheaper price to return them. It's also incredibly risky. Think about it. When you buy a stock, the most you can lose is what you paid, right? It can only go to zero. But a stock you're shorting could, in theory, go up forever, which means your potential losses are unlimited. And within the world of going long, there are two main schools of thought. First, you have value investing. Think of these folks as the bargain hunters of the stock market. They're looking for good, solid companies that they think the market has unfairly overlooked or underpriced. On the other side, you have growth investing. These investors are all about the future. They're looking for the next big thing, those innovative, fast-growing companies that could be the rocket ships of tomorrow, even if they're a bit riskier today. Okay, now for a really fun part. Let's do a little lightning round of Wall Street slang. This is the lingo you hear thrown around that can make you feel like you're not in on the secret. Well, not anymore. You ready? First up, to the moon. When you hear this, it means a stock's price isn't just rising, it's skyrocketing. It's that feeling of just explosive, almost unbelievable growth. Next, a unicorn. In finance, this isn't a mythical animal, but it is almost as rare. It's a private startup company that hits a valuation of $1 billion or more before it even lists on the stock exchange. This next one has a memorable name, a dead cat bounce. It's a little grim, but it's very descriptive. It's when a stock that has been crashing suddenly has a small, temporary recovery. It looks like things might be turning around, but it's a false alarm, and it's usually followed by the price falling even further. And then there are the whales. Just like in the ocean, these are the biggest players. It's slang for huge investors. We're talking giant funds or super wealthy individuals with so much money that when they buy or sell, their trades are big enough to actually move the market. They literally make waves. And finally, this is a really important one to know just to protect yourself. A pump and dump. This is a totally illegal scam. It's when fraudsters spread fake news and hype to artificially inflate a stock's price. That's the pump. Then, once the price is high, they sell all their shares, the dump, and the price crashes, leaving everyone else holding the bag. So there you have it. From the absolute basics of what a stock is, to the moods of the market, and even some of the insider slang. You now have the vocabulary, the translator's guide, to follow the conversation. The language of Wall Street is no longer a foreign one, which leaves just one question. Now that you know the language, what are you going to do with it?